try to get a mentor. You're going to need it anyway to get a loan, even if you have the highest net worth. But if you go out and you have no experience in operating multifamily, you're going to need somebody who has that experience running multifamily.
Commercial is not as much of like, we're going to make sure that Wayne can pay for this. It's making sure the asset can pay for it too. But there is that like gray area, if you will, of like,
there's not a one size fit all. Like if you can get an $800,000, $2 million asset and you are the main owner of it, that will add zeros to your balance sheet over time. It's weird to say this, but it's easier to do bigger deals than smaller deals.
What's going on, guys? Back with another podcast here. We've got Wayne Courreges III. He's a multifamily and self-storage investor out of Texas with CBRE Partners. He's got at least $15 million in assets and just a big guy down in Texas. We're excited to have him on the podcast. For you guys that are just getting into commercial real estate, multifamily is a great way to get started, and Wayne's here to help us out with that. So, Wayne, thank you so much for your time, jumping on the podcast. And if you want to give everybody a little bit of an introduction of yourself, how you got started in commercial real estate, I'll give you the floor. Appreciate you.
Well, thanks for having me on, guys. Looking forward to sharing my experience and sort of how I came into this. So 2003 to 2007, joined the Marine Corps, or was in the Marine Corps during that time. And it was right after high school. So like 2 days out of high school, right in, and bought my first single family home rental when I was 19. I was in 29 Palms. And so started pretty early, but I got the bug back in high school with one of my good friends. Her dad was a developer in Austin, so got a lot of exposure to real estate and, how it can, change, lives, et cetera. So got the bug early, joined CBRE in June of 2007. So right after getting out of the Marine Corps, and served or was with them for about 16 years. Which was, a great, really great experience. I had a lot of leadership opportunities and portfolio size with them, heavily on like asset management, property management. And so in 2019, I had just finished going back to like an MBA. I went to North Carolina for my MBA. It reduced my entrepreneurial spirit. And so I started CREI Partners while working for CBRE. And then in June of 2023, left the W-2 world to go all in on our investments. So at this point, we've got about 60 million assets under management. Bulk of that we're lead sponsors on. And so what that means is we'll find the deals, we'll finance, go through everything, raise the capital, and then run the day-to-day on the asset management side. Primarily, it's multifamily. I would say 80% is multifamily, and the other is like retail, storage, and some development.
Cool.
That's awesome.
First of all, thank you for your service.
You as well.
I want to discredit that a bit. Yeah, thank you. The transition cannot always be easy, and you transitioned not only from the military into a job, but into CBRE, which is pretty big time. I'm curious kind of how you made that switch and jump and all that.
Yeah, so I don't know how I came across Lucas Group. I really don't remember how I came across them, but I was trying to get actually with Trammell Crow Company, wanted to be on the development side, and CBRE had just merged or acquired Trammell Crow, and so got on with Lucas Group. I don't know if you're too familiar with them. Are you familiar with those guys? Yeah. It's like Orion, Lucas Group. They're big, like military. They help people getting out of the military, find opportunities.
Gotcha.
And, these companies, a lot of them have like a military officer program where they will, they'll hire these officers that have experience of leadership, right? They don't have to train leadership. They just have to train a skill. Now, I wasn't an officer. I was a corporal, but I had my degree. And, I was, sort of, I don't know. I would say, I don't know if I was annoying at that point, but I was like, I really wanted to get in the door with CBRE. They were at this conference. Lucas Group was hosting it, but 99.9% of everybody there was an officer. I was able to get in, and was hired 2 weeks later, and, was in Washington, D.C. for a while, Houston, Austin, and back to Houston. So, but anyway, right now we're based in Bryan, Texas, and got a couple full-time team members. And so we're growing we're still small, we're, small company, but we are growing, and that's exciting to see.
That's cool. So walk us through, you said your portfolio is 80% multifamily, and then you got storage and retail. I guess walk us through how, I'm just curious, Jesse and I work at a firm called City Plat, and they have kind of a structure of how they run deals and take down deals is similar, where they've been building their portfolio. So how have you guys set that up in terms of like your team structure? So you guys are the GP. Is it you and another managing partner? Is it just you and then you have your teammates? Or walk us through kind of your organizational structure if somebody wants to go and build their own like you said, you switched and had the entrepreneurial bug and started your own company. So if somebody wants to go start their own commercial real estate investment company, walk us through kind of the structure of how they do that.
So now where did we start? So for those that are like wanting to get into commercial real estate, I would say first try to get a mentor. If you're coming in, especially coming in from another industry and you're jumping right in, trying to, you got to have, you're going to need it anyway to get a loan. Because if you go out and even if you have the highest net worth, but if you go out and you have no experience in operating multifamily, you're going to need somebody who has that experience running multifamily. So I think it all starts with just building your team, and part of your team is your mentor, but also and they don't necessarily have to be a general partner with you, but they will look at the underwriting, look at the deal, ask questions, help you out that way. Obviously listening to this podcast and reading books, and it's heavily on the education. Now on the general partner team, that changes over time. I guess when you first start, you may not have the liquidity or the net worth to get the loan. So it's as simple as like, what do you bring to the table to get the loan, and what do you need to bring? Think of like a football team. Like you may be the quarterback, but you're going to need a receiver, you need a running back, you need your lineman. Like you're going to need players. And so, I would say, net worth, liquidity, they are also called as a key principle. If you're first starting out, you're going to want somebody who has the experience in operating in real estate, particularly, ideally the asset class that you're looking to buy. You're going to need partners to help you raise capital, because if it's your first time, you're going to likely be going to friends and family, and they may not be a little skeptical of, your ability to do it, even though they like you as a person, they love you, whatever in the family. But, you just got to want to build that team and show like, okay, it's not you just running the asset, or you've got a team. So, and you're going to need that again for any lender to give you that loan. So that's where I would start. I mean, there's a lot of auxiliary type partners. You're going to a Security Exchange Commission, SEC attorney, because anytime you're raising capital, you're selling a security. And so you need to follow SEC guidelines and blue sky, filings, etc. So the SEC attorney's very important. Separate of that, you're going to want to find like a real estate transaction attorney. Someone's going to help you, guide you through the contract process. Make sure you're reading the loan documents. You're going to want that attorney as well. So, and then you need your property management team. So who's going to be the day-to-day boots on the ground running property management? If you're first starting out, you're not going to be managing the property. Likely the lender is going to require a professional managed company. So when I first started, we were heavily focused on San Antonio. At that time, we didn't buy anything in San Antonio, but we built a lot of relationships with some great property managers. So, I mean, the list goes on. It is a lot of, you're just building that team and building relationships, going to a lot of meetups, et cetera, to, find people that, are willing to partner and, give you a chance. I mean, if you're starting out, that's, you're looking for someone who's going to give you the opportunity to partner.
Yeah, honestly, you're really looking for a bank that's willing to take a chance on you at times. Commercial is not as much of like, we're going to make sure that Wayne can pay for this. It's making sure the asset can pay for it too. But there is that like gray area, if you will, of like, or are we going to take a chance on Wayne and as him and the operator and things like that? So it's definitely good points. When you were looking for your deal, your first deal, did you like what size? I'm curious what size that you went for in multifamily. Like, did you find a property that already had property management? You were talking about property managers, so I wasn't sure if you were buying something smaller. Talk about that first deal that you found.
Yeah, so the first syndicated deal I did was 101 unit multifamily in Houston. So I was always targeting 100 plus in unit count. At the time,
Mm-hmm.
I was looking, I was okay with 70s product. That's changed a little bit now. I'm more in the 80s product just because, from a valuation standpoint, you can get, a newer asset versus, a few years ago. So anyway, so I went with that. It was found off market. I did, a lot of grunt work and finding off market sellers. And, that took about a year and a half of building the relationship with this, owner and then getting the opportunity to buy it. And and so we did that, and that was in 2022.
Okay. Dang, in 2022 as well, that's like kind of like a tough time to get in. Something I was thinking about as you were talking is you said that you were in CBRE for 16 years, and then that's when you made the jump. That could be like a tough time, if you will, to make the jump into syndication and doing your own thing. I know you mentioned that you had that motivation coming out of MBA, but I was wondering, curious, like what gave you that spark to go do your own thing after you've been in CBRE for 16 years?
So, I mean, going back to back in high school, I mean, I had this dream of owning a real estate company and growing our investments. So I just think when there's just different chapters in lives. And so when I joined, CBRE, I worked really hard, a lot of hours, and dedicated a lot of, time to grow our clients' investments. I mean, that was, and our clients at the time were like JP Morgan, MetLife, Invesco, TIAA-CREF. These are big institutional clients that would hire, like a CBRE to come manage their portfolio. But I would say, it paid really well and great benefits, things that are important when you're growing a family. And at that time, I had young kids. I've got a 13, 12, and 10-year-old. So the majority of the time that I was with CBRE, we had kids. And so your risk being an entrepreneur and going out, sort of subsides when you've got a family to feed. And so, I did it in a way where, I always like to say my 9 to 5 paid for my 5 to 9. Like while I was doing, in essence, both, it was a lot of hours and a lot of sacrifice. It was, you're doing a podcast. Like I was doing a podcast nights and weekends because I couldn't do it during the day, but all that stuff, was like taking time away from family. And so there was definitely some sacrifice. And it got to a point where the portfolio, as we grew, it was hard to do both. I didn't leave my W-2 because I hated my W-2. Like it was a good team, good people, great company. It just was hard for me to like focus on like what I was supposed to, what I was getting paid for. Right. And then focusing, my mind being on, CRI Partners investments. And so I just, one day I went to the office and I called my wife and I was like, if we, I'm thinking about giving my notice, or we lose everything, are we good? I mean, cause I've always been like the provider, and at that time when we had grown the portfolio, again, we didn't do this in a way where it was like, oh, we're just going to quit and go do a real estate company. I highly advise to do that. I mean, it was a few years of building a business and getting it to a point where, we could, we would be okay. But it's still that safety net that I was, you just get comfortable. So I don't know if that answers your question, but ultimately it just was timing. I mean, if I was having kids and, things were different, like I wouldn't, for me personally, I would be feeding the family and focusing on that first. And then, but it was just a different chapter. It was a chapter in my life that allowed me to be more entrepreneurial and risk taking.
Yeah, no, I think that makes a ton of sense. You have all these desires and passions and stuff, but sometimes it's not always the best time to do it. And I totally get that. It makes a lot of sense to me. So, and I think there's lots of good lessons there too. Like you don't want to just rip the Band-Aid off if you can't, make things happen, ends meet. But so going back to that first syndicated deal, you mentioned that was your first syndicated deal in 2022. What was let's take it back even further. What was like the first deal that you did, not the single family house, but the first like multifamily, first true multifamily deal that you did, and how you took it down?
Yeah, so that was the one, the first full multifamily was the one in 2022.
The 101 in Houston, right?
Yeah. Mm-hmm. Yeah, I worked at 2003 to 2007 to 2023. And so my first deal that I took on was the 101 unit. And a lot of it, it was off market. And then you're just working and finding partners to help, bring in what you can't bring in. So,
yeah, I'm curious. So obviously, like you said, we say the same thing a lot. When you go out and do your first deal, you need to get a mentor involved, and you can't really just do it yourself. Otherwise, you could get in trouble. So you should go have a mentor for sure. But you said you went out and found a 101 unit for your first deal. So we bought a $250,000 industrial building for our first deal. Very small, very manageable. We had mentors helping us, but we bought it on our own. But I'm not going to say it's nothing can go wrong, but it's harder to lose on that size of a deal when the payment's, $1,800 a month. So like worst case, we could cover it, split it. But, I've always heard people say and mentors say, which I'm now realizing like, you may as well do bigger deals because it's all the same. It's just, there's an extra zero on it or whatever. But you're doing the same amount of work for the same amount, like you're doing the same amount of work for a bigger deal you are for a smaller deal. So we're kind of in that stage where we did a $250,000, $800,000, and then a $450,000 deal just on our own. In the last year, which in the commercial real estate world is small deals. To us, $800,000 wasn't small, but, there's a good returns there's good cash flow, but we're kind of at a point where we might be pivoting to like, hey, let's go for a little bit bigger of a deal, like a $2 million deal. or maybe a $3 million deal. What kind of advice would you give somebody who's like kind of towing that line? Which one do you think is better to go after? Because, if you syndicate like you did, you got 101 unit. I'm sure your cash flow on 101 units is probably a lot more than our $250,000 deal. You might not own as much of that deal, but you might make a lot more cash flow. So I'm just wondering, what do you think about that? Are you ready to stop thinking about commercial real estate and actually earn money from it? Many investors wonder how to make serious money from their first deal, but the answer is here. J. Scott Shield, the founder of Commercial Academy, is revealing this strategy in his free online masterclass, how you can make $1 million from your first deal in commercial real estate. This isn't information you're going to find anywhere else for free. It's really invaluable. So don't delay for your financial breakthrough. Get the playbook that enables you to make your first million in your first deal. Text masterclass to 888-653-1199. Again, that's 888-653-1199. Immediately for instant access. Your path to significant wealth starts now. Remember, it takes one deal, one time to change your life forever.
Unlock the blueprint to a 7-figure payday on your very first commercial real estate deal. Let me tell you how. J. Scott Shield, the visionary behind Commercial Academy, has condensed years of expertise into a powerful, free masterclass recording on how you can make $1 million in your first deal in commercial real estate. This is your chance to learn directly from the source, understand the principles that drive massive profits, and equip yourself with the knowledge to hit the ground running. No cost, no commitment, just pure actionable value designed to kickstart your commercial real estate success. It's incredibly simple to get started. Text Masterclass to 888-653-1199 now to claim your success. And again, text Masterclass to 888-653-1199. Discover why one deal, one time can change your life forever.
A lot of different ways. So on that 250,000, do you have outside investors, or is it?
We have one investor on that deal who brought all the money. We did all the work.
Yeah. So y'all split like 50-50 on that?
Yeah, 50% to the investor and then 50% to me and Jesse.
Yeah. Mm-hmm. So I wouldn't really look at it. So this is just my opinion. I wouldn't really look at it because there's a lot of people, like people say, for me, we have 60 million assets under management, but how much of that do I really own? Right. Mm-hmm. And for us as the lead sponsors, we own for every deal. So it's split like 75% is limited partners, right? So those are the people bringing in the capital for us. 25% is owned by the GP. Within that 25%, anything that we are controlling, we typically get 50% of that, right? I'm just opening the playbook here. So like maybe of the entire deal, I'll own 13% of the entire, 12 or 13% of the entire deal. Right? Because most of it's LP. So I would say, don't really look at the numbers. I mean, people go into these conferences and are like, oh, I own all this stuff. But you look at like their balance sheet and they're like, man, you're richer than them. It's just because like they own like 1 or 2% or, like at the end of the day, there's not a one size fit all. Like if you can get an $800,000, $2 million asset and you are the main, owner of it or 50% of, that's, that will add zeros to your balance sheet over time. Does that make sense?
Yeah, for sure.
Yeah. I think if you're, so I wouldn't really be, you would want to do bigger deals.
Just for the sake of doing bigger deals.
I don't know. So for me, it's weird to say this, but it's easier to do bigger deals than smaller deals just my experience. And you got to remember, like my whole background has been in commercial real estate. So like when I joined over, so if you're just starting in commercial real estate, I think you said like a year ago, like you are doing incredibly well, building the portfolio. And over time, the small deals are going to get a little boring. I mean, that's really, you're going to be like, okay, I can do this, but now like it's time for me to do a little more and more. It's going to be a personal decision. I do think that it's easier to do bigger deals, easier to get people excited about it. For multifamily, the debt is really good. Non-recourse, typically you can get 65, 70, even upwards of 75% leverage. And so with that, I mean, you're absolutely right. The people have told you, like, it is the same amount of work. Like I've gone through many closings and, a land deal or a multifamily or, single family, it all goes through the same closing process. Earnest checks typically get better or bigger. And so that's also kind of like, at a time, I could be doing $60,000 to $100,000 equity or earnest checks or being responsible, even if I have someone else, assist with that earnest check, like I'm guaranteeing that they're not going to lose their money. So there's more risk. And when I say not losing their money, like if the deal doesn't close, I make it right where they still get their money back. Right. And so it's just a different risk profile. It's just what you're comfortable with. And then what your team looks like. Are you surrounded by, higher net worth individuals who you can raise capital from? There's not a, one size fits all. I was on a podcast yesterday and, the guy has like, it was pretty incredible, like over 100 single family homes. And, we were talking about, and for me, I prefer not to do single family because 100 homes means 100 roofs, 100, everything, where, I can have 100 units under 3 roofs and 1 boiler, and I don't know,
It's economies of
scale and the ability to, go from there. But there's been a lot of people that have lost a lot of money over the last few years because they scaled too quickly, and they didn't know what they were doing. And so I think I credit you guys for, like, don't underestimate like the 250, 800 to, if you go to 2 million, like, what is your real ownership of it, right? And you have to, I'm not asking that to y'all direct, but like, that's the mindset I would think is like, are you really growing your wealth? In my opinion, it seems like you are. So good job.
Yeah, no, thank you. Appreciate that. Yeah, our thought in the beginning was we'd rather own more of a smaller portfolio than less of a larger portfolio. And I feel like there's, people choose different routes. Like some people like the syndication route and have a full on business like yourself, and you have investors and reporting and all that stuff. And that's what people love. And there's absolutely nothing wrong with that. And then there's other people we come across, like we've had a mix of investors on the podcast. Some people just prefer to keep it much smaller and they're doing smaller deals, but like you said, they own more. So it's kind of like, it's really just like which one you prefer. We were thinking maybe trying to go after the smaller deals, owning more of them. And so our main goal is cash flow. So like it sounds obvious, but we want as much cash flow with as little real estate as possible. So like that way there's not as much debt and it's low risk and stuff like that. So we were just thinking if we go to like a larger, like $1 to $2 million deal, then ideally we could still keep a large portion of it. Like you said, bring on maybe one high net worth investor who funds it. We keep maybe a little less than 50%, but it's cash flowing substantially more. So it could, move the needle for us. And still in the grand scheme of things in the commercial real estate world, $2 million is kind of not small, but it's still not a big deal by any means. To us, a $2 million deal, we'd be like, whoa, that's big. But
well, I would say like where I live, like, man, finding a house under $1 million, it's hard to, I guess it just depends on where you are in the country and, what land values and stuff we're going for. But, ultimately you want to, I like that, you had mentioned, obviously there's risk scales, right? And so, you had mentioned that the risk of the 250,000 that your mortgage is 1,800. And so in the worst case, you can split it. So, obviously you're doing a good job thinking through the risk standpoint. As you do bigger deals, like we collect about 150. I'm just throwing out an example. I was looking at one of our properties, 128 units. The income on that's about 150,000 a month. Our mortgage is 60,000 a month. And so, when you start looking at, the cash flow, obviously we got to pay expenses, which is typically about 50% of total revenue, including taxes and insurance, payroll, et cetera. So the rest of it is cash flow. So there definitely is more cash flow and opportunities. But at first, guys, you're not going to be able to own what you are owning on these smaller deals because you're going to have to bring in people who can help you get that experience. So it's definitely a long-term game. And what I would say is, unless you enjoy the stress and dealing with asset management and the ups and downs of multifamily and dealing with eviction courts and things just out of your control, like Fannie Mae. Fannie Mae is a great lender. We have loans with them. Typically with Fannie Mae, it's government backed, so lower interest rate, fixed rate. But in a Fannie Mae loan, you have to give, if a resident doesn't pay, you have to give them 30 days notice. So residents learn pretty quick, like, oh, I don't have to pay rent until I get a notice, and then I don't have to pay rent for another 30 days. So it's like this government, like, come on, man. So it's, it hurts you on the delinquency. They pay, but everything is just delayed a month. So anyway, my point is just do what you're passionate about, what you're excited for. Maybe you're more on the capital raise side. You want to raise capital more, you're on the operations. I would say anybody that's doing bigger deals, sort of find your lane and then go find a team that you can add value to.
Yeah, that's great advice. That's the other thing too that people talk about commercial real estate versus residential is that it's a team sport. Like you're going to build a portfolio, you're going to have a team, you're going to have an attorney, property manager, and then even within the GP, like you said, you might have somebody who's responsible for capital raising, other person's responsible for managing or like asset management and so on and so forth. So yeah, I think that's a great point. I'm curious, what made you pick multifamily? Is that what you were managing at CBRE, so you felt comfortable with, and that's what you went into, or was it the attractive debt? Because I know a lot of people go into it based on the debt. I mean, non-recourse is awesome.
Great question. So in 2019, I had this bug to start CRI Partners, but I needed to keep my day job. So I was like, you know what? what is CBRE not doing where I wouldn't compete with them? And multifamily, they don't own multifamily. They don't manage multifamily. So I spoke to, my leadership team, and, they were fine with me doing this. A lot of the things that I was doing was transferable, whether, from the accounting side, operations, tenant relations, capital expenditures, et cetera. It's all pretty transferable in different asset classes. But yeah, that was a big start. So I got a mentor. I took my advice that I gave y'all is get a mentor. And even though I knew asset management and, I knew commercial real estate very well, underwriting, analyzing deals, just leveraging their team, because that's a big thing. Is like we mentioned a bunch of team players, but how do you know which one is good or not? And so if you get that, and I'm not a mentor, I'm not trying to sell my business. I don't do mentorship, but there are people out there and they will make those connections with property management companies, attorneys, if you do it on your own, it could take, several years to get to a point where you could probably get, much quicker to what your goals are by doing, so learning how to underwrite, source a deal, maybe there's a lender relationship that mentor has, you can go that route. So
yeah, we tell people all the time that like the fastest way to accelerate your growth is not to go buy a bunch of buildings. It's to get around people who are doing deals and doing what you want to do. That's the fastest way by far. Yeah. And if it's a mentor, that's great. So like we joined the firm we're at, City Plat. I joined them. I've been in real estate for 7 years, brokerage. I was doing brokerage for the last 7 years. And I switched to this firm I'm at now, City Plat, almost 3 years ago. And it's basically like what you guys do, but they have a brokerage arm. So they have a portfolio of about $350 million at this point. In the beginning, they were kind of doing everything. Now they're focused on industrial primarily and some retail. So I've learned so much from them. The only reason we were able to do what we did last year is just watching them and just soaking everything possible we could, and just learning. So there's nothing more valuable than being around a group of people who are doing what you want to do and that you can learn from. That will by far be the fastest way you can grow. Yeah. I'm curious, you mentioned that you're in an RV right now and you guys are going to be taking a trip. Where are you guys going?
So we're doing a 9-month RV road trip. So we're heading to, we'll be in Montana soon, and then we'll be heading to Wyoming and then South Dakota, and then heading over to Minnesota. Not Minnesota. We'd be in Wisconsin, do Michigan, and just keep going east up to, I don't know, Vermont, New York. I guess it would be New York first and then head down. So yeah, we're excited. Yeah, I've got 3 kids. We're bringing our 2 dogs. But honestly, that's what commercial real estate can provide. Now we're testing. I'm in my RV right now testing this internet. I have Starlink, right? I'm in my driveway at the home. We leave Saturday. So, with Starlink, I've let our investors know, what we're going to be doing, but that doesn't mean we're stopping what we're doing. Like in the mornings, I'll be connected, be working. My kids will be homeschooled, which they're not normally, but we're going to do it for the next year. And then I'll be back, checking on properties every 6 weeks. I also have, a couple full-time team members, that are here in Texas. So boots on the ground. So yeah, we're excited. We're going to see a lot. We've talked about it, my wife and I, several years, even when I was a W-2 employee. It's hard to take a year off from your corporate world. So I was able to take advantage of this and see where it takes us. We're not selling or renting our house. So like if we get 2 months in, we're like, man, we're good. We need more space. We can always turn it around.
That's awesome. That's like a dream for me. I have 3 kids as well, and we love camping and stuff. We haven't taken them much since they're all very young. My daughter's 5, my son's 3, and my other son's 1. So we're actually going camping this weekend in Shenandoah. So I'm excited, but that's something I would love to do. And like, that's the goal. And I feel like that's why a lot of people get into commercial real estate or real estate in general, just to do stuff like that, travel, be with your family, do what they're passionate about. So that's really, really cool.
Yeah. Our kids were super young when we started quote unquote RVing. We started up with like a pop-up trailer. So it gave you some comfort, the HVAC, but had like that canvas tent feel. And so I stopped, we sold that probably a year in because every time it rained, you got to wait for it to dry out before you put it back together. And then we bought a travel trailer, had that for a few years. We still have it. And then we have what we have now to go travel with the country. But, but here's the thing, guys, like, especially when you are leading real estate investment companies or your investors are trusting you to, deliver on the business plan, like that's a huge fiduciary responsibility. And it's a multi-year. So, even as we're going, we're staying in camps where there's solid internet and, connections. You're running thing with the real estate. It's not easy to sell 3 months, year, it takes multiple years. And so systems and processes and those teams, do come to play, so you can do these type things, but there's still work, right?
Yeah.
So
you got to set it up right.
each one is its own business. And so you got to make sure that each business is performing.
Yeah, 100%.
Yeah, I think a lot of people do get that mixed up. They think that you're just out here just probably just enjoying having a 9-month vacation, but it's not really that. It's so you can have time and location freedom. Like that's what everybody really should be chasing, right? So I think that's probably a pretty good segue into. You said that you also do some retail business, storage and stuff like that. Have you looked into doing RV parks or anything like that as well?
I have thought about it, but no, it's not really, for us, for me personally, I have a hard time being good at multiple things. I've just never been that guy who was good at everything, there's probably that one person you can think of in high school, whatever, who's could do everything, anything pretty easy. So I've really just heavily focused on multifamily. I've doubled down on multifamily. There have been a lot of people that have left multifamily as an industry, which has been good for us because there's less competition. We've been finding incredible opportunities. So I just double down on multifamily. Now there is, and for us, it's cash flow. We love the tax depreciation. We like the debt, all the things that, why, people should look at multifamily. At the end of the day, people need a place to live. It's historically done well. But the other piece, and it's not even really traditional storage, they're all 20 by 50 size units, or they're 1,000 square feet, 14 by 14 foot roll up doors. Think of it a step down from flex warehouse space, because they do not have the offices. But you got a lot of business, HVAC, generator, disaster recovery, high-end RVs, boats, Parks and Wildlife even rents from us, like Texas Parks and Wildlife. So you're, it's a different segment of customers that need this large space. But what I like about it is it cash flows really well once you get it leased up, because the expense ratio is 32%, whereas in multifamily in Texas, it could be 50 to 55%. So anyway, so there's just additional cash flow that comes through it. But it's also much more, I don't know, when I say retail, so we third party our management for all our multifamily, which some people vertically integrate that once they get enough experience. We've intentionally decided not to, because it's better. I feel like it's easier for us to scale when we're partnering with a group that's all in on property management. That's what they do. That's their unique ability, and so we'll partner with third-party management, but on the storage, we have the storage facility. We are the ones managing it, and we can do everything remotely. We don't, and there's no emotions, guys. You're not taking someone's home away if they're not paying their rent. You're just telling them to get their stuff out and clean. So there's also those benefits as well.
Yeah, you mentioned unique ability. I'm curious. I'm assuming you probably read the book 10X is easier than 2X.
Yeah, and I'm in Strategic Coach. Highly recommend. Yeah,
that's awesome. Have you So yeah, I'm big into that. All those books are amazing. I absolutely love those books. And then Ben Hardy, you might have seen it, just came out with a book called The Science of Scaling. Have you seen that yet?
I haven't yet, no.
Oh, I listened to it. It's a game-changing book.
What's it called?
It's called The Science of Scaling, and it's Ben Hardy's first book on his own. And it's so good. It's so good. I binged it in a day, and I'm probably about to reread it. So
the book that
most
recently, I put that in my Science of Scaling. About a year ago, I read Buy Back Your Time. I don't know if y'all have read that one, but that was, for me, a game changer for how we schedule my calendar and and then and the Strategic Coach has been good, because I'm part of some real estate masterminds, but Strategic Coach is more an entrepreneurial mastermind, so it's been good for me on that as well.
That's awesome. Yeah, masterminds and books, that's another huge thing. Obviously, we're a part of Commercial Academy. They sponsor our podcast, which is awesome. We're going to Cleveland. By the time this airs, it'll be done, but we're going to Cleveland next week for a mastermind there, which is super exciting. And then we're also going to a one-off mastermind in September, specifically for somewhat similar to what you described, but Small Bay Flex. It's a Small Bay Flex boot camp, 2 days, talking about how to run them, find them, manage them, all that stuff. So I'm really excited about that. But it's very important to be in that kind of stuff.
Yeah.
Awesome.
Yep, Robin, and because you sort of you get surrounded by people that are doing what you're doing, and you realize you're not the only one. You're not the only crazy guy that's doing it, because most people aren't doing this in your circles.
Yeah, definitely not.
Yeah, definitely not. So tell us what CREI is up to these days and what you guys are looking for in the future.
Yeah, so we just closed on 127 units in San Antonio. We've got another deal under contract. We're closing in San Antonio next month. That would be September 25. Cool. We have one large, like 12-acre property in Bryan, Texas that is going to be like, I would say mixed use. You got your multifamily 150 unit. We've worked on that for about a year and a half. That should, shovels in the ground should start November, December of this year. Then we have a hotel that we're working through with Marriott on the application process, hoping to get a Spring Hill Suites built. And then we have an office retail component. So that's heavily on the development side. Again, that's, small part of our portfolio. But, the goal is, buy, cash flow and multifamily over the next, however many years. I don't see myself ever stopping this. I don't know anything different. Someone asked me, what would you do if you had all the money in the world? I'm like, real estate. Like, this is what I do. So, I'm always thinking it. So,
that's awesome.
But yeah, that's what we'll be doing and distribute. I had some investors be like, so what does that mean when you're on this trip? What does that mean with distribution? There's nothing better than giving distributions. So like, I will absolutely be giving distributions as I do my road trip.
That's awesome.
Yeah.
Awesome. Well, thank you so much for coming on. If people want to connect with you, find out more about your business, what's the best place to do it?
Yeah, I know we talked a lot about active investing, find deals, but sometimes the best way to start in commercial real estate syndication is actually investing passively. We get a lot of investors who want to who invest, become a general partner, but before they do, they want to, see how it works. So they invest as a limited partner. So I would say go to passiveinvestorcoaching.com. Even if you're an active passive investor, like it's 5 hours of content and it's free. And it talks about how to look at a deal from a passive investor side, how to look sponsorship team, et cetera. So, passiveinvestorcoaching.com. And then you can also go to CREIpartners.com, just learn more about our company. But, for those that are listening and you're obviously hungry for education and stuff. So definitely, it's free. There's no like gotcha gimmick or anything. It's just my way of giving back. So it's passiveinvestorcoaching.com.
Awesome. We'll check that out.
Awesome.
And we hope you guys enjoyed listening to this episode and we will see you in the next one.
Thanks, guys.
Thanks, Wayne.